Vietnam closed 2025 on a positive note, with GDP growth reaching 8.0% as momentum broadened across the economy. The industrial sector remained the key driver, expanding 8.9% year-on-year on the back of resilient manufacturing. December PMI rose to 53, signaling continued gains in output, new orders, and employment, which translated into strong trade activity, with exports and imports increasing 17.0% and 19.4% respectively. Construction provided additional support, driven by a 26% rise in state investment and improving real estate conditions, while this momentum flowed into services, which grew 8.6%, led by trade, transportation, and a record 21.2 million international tourist arrivals. Despite concerns around potential U.S. tariff risks, foreign direct investment remained firm. FDI disbursements reached USD 27.6 billion, up 9.0% year-on-year, underscoring sustained confidence in Vietnam as a manufacturing base. Manufacturing accounted for 82.8% of total disbursements, with global players such as Intel, Foxconn, and Toyota expanding production. Feedback from industrial park developers indicates that foreign manufacturers are accelerating localization by shifting more production to Vietnam to mitigate transshipment risks, supporting medium-term manufacturing growth. Inflation remained well contained, with December CPI rising 3.5%. Price pressures stemmed mainly from higher food and dining costs following changes in the household business tax regime, adverse weather, and rising construction material and rental costs, partly offset by lower transportation costs due to declining gasoline prices. Looking into 2026, GDP growth is expected to stay around 8.0% as Vietnam enters a new 5-year leadership term with a continued pro-growth policy stance and faster project execution. Infrastructure investment is set to accelerate, with 2026 marking the launch of several large-scale projects across transport and energy. Supported by a USD 9.5 billion budget surplus and public debt at around 34% of GDP, fiscal space remains ample. Stronger public investment, together with recent increases in personal income tax deductions and adjustments to tax brackets, is expected to lift household incomes and consumer confidence, with retail sales growth projected to return to double-digit levels in 2026. The VN Index continued its upward trajectory in December, rising 5.9% and bringing total returns for 2025 to 38.8%. Market sentiment was underpinned by resilient macroeconomic conditions, Vietnam's upgrade to FTSE secondary emerging market status, and the resumption of IPO activity, which together lifted average daily trading value to USD 1.1 billion, up 31.2% year-on-year. Despite the headline performance, market gains were highly concentrated, with Vingroup-related stocks accounting for 69% of the index's total return, despite limited improvement in the group's underlying business fundamentals. The rally was initially fueled by expectations around Politburo Resolution 68 and later amplified by Vingroup's proposal to participate in the USD 67 billion North-South high-speed railway, alongside the launch of other capital-intensive projects such as the Ben Thanh Con Geo Metro line and an LNG-fired power plant. As these projects progressed, funding requirements rose materially while leverage remained elevated, with a debt-to-equity ratio of 2.0 times as of the third quarter of 2025, ultimately leading the group to withdraw from the high-speed railway project. At the same time, VIC's free float remains highly concentrated, with 173 investors controlling 92.4% of voting rights, while valuation remains demanding at 9.1 times 2026 forward PB. The financial sector was the other key driver, accounting for 23% of total gains, supported by solid credit growth and improving asset quality. Together with Vingroup-related stocks, these two segments contributed around 92% of the VN Index's total return, highlighting the narrow breadth of the rally. Meanwhile, foreign investors remained net sellers, with cumulative net outflows of USD 5.2 billion, nearly half of which were concentrated in a handful of large-cap stocks and ETFs. Our portfolio increased by 0.8%, bringing the full-year return for 2025 to 14.4%. Vingroup-related stocks have materially skewed the VN Index's headline performance. Excluding these names, contribution of the remaining constituents would be 12.0% only. As highlighted consistently in our fact sheets throughout the year, we think the rally of Vingroup-related firms is insufficiently supported by underlying fundamentals, while the group's multi-layered ownership structure continues to pose challenges for valuation. Looking ahead to 2026, we expect the market to shift toward a more earnings-driven phase. EPS for the top 100 companies is projected to grow by 12.2%, while Vingroup-related firms are expected to account for only a small fraction of this growth, pointing to opportunities in overlooked companies with stronger earnings momentum. Market liquidity should also improve as foreign investors return around the implementation of the FTSE Emerging Market upgrade in September 2026, supported by deeper engagement from global asset managers and continued progress toward MSCI Emerging Market inclusion and sovereign rating upgrades. Overall, 2026 represents a favorable window to initiate or increase exposure to Vietnam equities. A backdrop of declining global interest rates is supportive for emerging markets, while Vietnam is positioned to remain among the fastest-growing economies over the coming decade. The country is entering a phase reminiscent of China in the early 2000s, where large-scale infrastructure investment helped drive consumption, corporate earnings growth, and long-term equity market performance.